Let's talk about the revenue recognition principle. First, let's define revenue. Revenue is the total amount of money a company receives from its customers. Note that this is not the same as income. Income refers to the profit that companies retain after expenses are deducted from revenue. So what is the revenue recognition principle? In accrual accounting, the principle states that revenues are recognized when they are earned, not when cash is received. Revenues are usually recognized as earned when a service has been performed. It is a generally accepted accounting principle that identifies the specific conditions in which revenue is recognized. Note that there is a second basis of accounting called the cash basis of accounting that records the revenue when cash is received, but cash basis of accounting is not acceptable according to the GAAP. Okay, let's look at two scenarios that use the revenue recognition principle. So Tanya is a gardener. One day, Tanya receives $70 cash from her customer, Jessica, in May to mow her lawn next month in June. So she has received the cash, but should she record it as revenue? No, she shouldn't. Tanya has not performed the service yet, and therefore the revenue has not been earned, even though she has received the cash. This is called deferred revenue, where the cash has been received before the service is performed. Deferred revenue is a liability because the revenue has not been earned and indicates that the service still needs to be performed and what is owed to the customer. Let's look at another scenario. This time, Tanya has mowed Jessica's lawn, but Tanya has not been paid yet, and she bills Jessica the $70. So should Tanya record this as revenue? Yes. Tanya has performed the service and therefore the revenue has been earned. She bills Jessica the payment and will receive it at a later date. This is called accrued revenue, where the payment has been earned but payment has not yet been received. Accrued revenue is an asset because it is revenue that has been earned and is a resource. Let's look back at some key points made. The revenue recognition principle states that revenues are recognized when they are earned, not when cash is received. Deferred revenue is where the cash has been received before the service is performed, and accrued revenue is where revenue has been earned but payment has not yet been received.